Howdy, everybody. Welcome to Liberty Call. Today is, what day is this? Wednesday, July 24th, 2024. Hope you're having a fantastical day out there in the interwebs. Pretty nice day here in Colorado. A little overcast. We've got some smoky smog in the air, and I guess it's from some fires over on the West Coast. I saw some, my favorite weather guy was pointing that out this morning, so I was a little surprised. I was unaware of this. You may have been aware. I'm, focused on other things like the markets and the economy and stuff. So anyways, hope you're having a good day out there in the interwebs. And if you could do me a favor, while the Astros are playing right now, they're up 2-1 on the lowly A's, which they've lost the first two, which I'm sorry, I'm getting off subject. If it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. Okay, let's get into today's numbers. It was an ugly day here domestically. Dow Jones was down 1.25%, 504 points, closed at 39,853. The S&P 500 down 2.31%, 128 points, closed at 54.27. The Nasdaq down 3.62%, 651 points, closed at 17,345. The VIX up 22.55%. It's at 1804 right now. Canada down 0.76, Brazil down 0.07, and Mexico down 1.02%. Headed over to Western Europe, Germany down 0.95%, the UK down 0.17%, France down 1.12%, the Netherlands down 1.26%, Spain down 0.02%, Italy down 0.48%, Switzerland down 2/3, and Portugal up 0.65%. Russian exchanges both in the green today. The MOEX up 0.75%, the RTSI up 1.62%, and the overnights, the Nikkei in Japan was down 1.27%, Australia down 0.09%, New Zealand up 0.65%, and in China, the Shanghai was down 0.46%, the Shenzhen Component down 1.32%, China A50 down 0.32, DJ Shanghai down 0.63, Hang Seng down 0.91, and the Taiwan weighted when it closed on the 23rd was up 2.76%. All right, good stuff. Let's get into the market recap. S&P 500 slumps as Alphabet Tesla earnings failed to impress. The S&P 500 experienced a significant drop on Wednesday, primarily due to disappointing second quarter earnings from major tech companies Alphabet and Tesla. Tesla's stock plummeted nearly 10% after it missed earnings estimates, reflecting a decrease in vehicle sales. The company's profit margin hit a 5-year low as it reduced prices to stay competitive, particularly in key markets like China. Despite these challenges, some analysts remain optimistic about Tesla's future growth prospects in areas like autonomous driving and robotaxis. Wedbush noted that while margin weakness is affecting the stock, the next phase of Tesla's growth story involving AI and autonomous vehicles is promising. Alphabet struggles. Alphabet saw its shares fall by 5% despite beating earnings expectations due to increasing advertising sales and strong demand for its cloud services. The underperformance at YouTube and continued weakness at Google Network weighed on investor sentiment even as search and cloud businesses performed well. Seagate's success. In contrast, Seagate Technology rose by 5% after reporting fiscal quarterly results that exceeded Wall Street estimates. The company's success is attributed to growing AI-led demand for data storage. Former New York Federal Reserve President Bill Dudley called for the Fed to cut rates as early as next week, reversing his previous stance. Dudley cited recession concerns and changing economic conditions as reasons for this shift ahead of the Fed's July 30th and 31st policy meeting. Now, here's what, one thing I find odd is, looking at the data, spending is still fairly strong. It hasn't really, flatlined or tipped over, at least as of the latest reports that I've seen. Unemployment still is, relatively low. The jobs or the unemployment numbers are still, they're a little higher than they were, a year and a half ago, but not obscene by any stretch of the imagination. So, I wonder, why is, the former Fed president, calling for the Fed to lower rates now? What does he want them to go to? Dropping rates 0.25% or 0.5%. how much stimulus is that really going to provide to the economy? I don't know. And I mean, yeah, it would be huge stimulus if they cut rates to zero, but we know what that effect has on the economy in the long term, as far as driving inflation over the long term, and how it just restricts long-term success. So, anyways. All right. More earnings news. Visa reported quarterly results that surpassed estimates, but the stock fell 3% due to slower payment volume growth, indicating a weakening consumer. RBC noted that U.S. trends showed a modest deceleration. Meanwhile, AT&T rose 4% after exceeding expectations for wireless subscriber additions in Q2, driven by higher tier ultimate unlimited plans attracting more customers. Texas Instruments reported solid second quarter earnings, meeting expectations and maintaining a stable stock performance. Overall, the mixed earnings results from tech giants and the broader market sentiment highlight ongoing concerns about economic growth and consumer spending, impacting investor confidence. All right, so that is everything there. Let's dive into some data that came out today. June new home sales. This was from First Trust. Mr. Bryce Gill, their economist, is the one who put this together. All right, new home sales were weaker than expected in June, continuing a trend declining of declining activity. Sales have returned to pre-COVID 2019 levels, stuck in low gear due to high mortgage rates. The 30-year fixed mortgage rates remain above 7%, leading some buyers to delay purchases in anticipation of potential Federal Reserve rate cuts that could improve affordability. Since the Federal Reserve began tightening, monthly payments on a new 30-year mortgage for a median-priced home have increased by 23%, assuming a 20% down payment. On a positive note, the median sales price of new homes has dropped 9.3% from its peak in 2022. This decrease is partly due to a lower price per square foot, which fell by 1.1% from 22 to 2023. Contrasting with the 45% increase from 2019 to 2022. Additionally, the mix of homes on the market now includes more lower price options as developers finish smaller properties. Supply pressures have contributed to this price decline, which the supply of completed single-family homes rising over 200% from the 2022 low. Total inventories reached a post-pandemic high in June, providing potential buyers with more options, unlike the existing home market that struggles with inventory due to homeowners holding on to low fixed-rate mortgages obtained during the pandemic. The Federal Reserve's long period of artificially low interest rates has led buyers to expect such rates as normal. They're not. Rates right now, this is normal right now. What we had the last decade and a half was not normal. That was extremely low, which unfortunately has pushed asset prices extremely high, because when you have, the lower the interest rate, the lower the payment, which then, leads sellers to push their price up so they can squeeze as much out of the buyer as they can. So it has an inverse relationship as far as, the price of the asset versus the interest rates that are current right now. The current higher rates, reflecting true economic fundamentals, have caused sticker shock for potential buyers. However, strong job markets and the realization that past low rates were an anomaly could lead to eventual market adjustments, meaning asset prices coming back down. Furthermore, the Federal Reserve reported that the money supply M2 rose by 0.3% in June and 1% over the past year. Following a surge during the early COVID-19 years, M2 declined from early 2022 to early 2023 and has stabilized since, which appears to be reducing inflation and slowing the growth rate of nominal GDP. All right. One more article for you. Excuse me. This comes from Zero Hedge, titled Interest Rates Are Too High, Blame the Mythical R-Star. This comes to us from Michael Leibowitz of realinvestmentadvice.com. All right. The U.S. economy is showing signs of slowing, and it will likely impact younger generations, especially renters, the hardest. Despite the Wall Street Journal's assertion that the overall economy is performing well, various indicators suggest otherwise. Jobless claims have risen to an average of 235,000 per week over the last month, compared to 211 in the first quarter. Additionally, continuing jobless claims are increasing, and retail sales have grown by only 0.2% in the past 6 months, failing to keep pace with inflation. Major banks are also feeling the strain from higher interest rates. JP Morgan's second quarter profit fell by 9% year over year, with credit card loans rising faster than spending, indicating more borrowers are carrying balances month to month. Charge-off loans have increased significantly. And where's the R value here? I was wondering when we're going to actually get to that. Did I copy the wrong information? Let me go back. Well, while we're here, let me take that off the screen. Sorry, folks. I apologize. It's like I've got the wrong information here. Copy. Uno momento. It'll be just a minute, and we can get this back up and running. It's like I don't know if I copied the wrong information. I might have when I was cutting and pasting earlier. So, yeah, this looks better. This looks much better. Okay, there we go. Copy, and let me erase this. There we go. All right, let's get back into this. Where am I? There we are. Get my notes back in front of me. All right. Yes, this is much better. All right. In the recent analysis, Michael Leibowitz discusses the current state of interest rates and their alignment with economic indicators. The current U.S. employment rate is 4%, and core PCE inflation is at 2.6%, which are both higher than their December 2019 levels. Despite this, the federal funds rate is now 4% higher than in 2019, which seems disproportionately higher given the slight increase in unemployment and inflation rates. Leibowitz attributes the high yields on bonds to a pronounced fear of another inflation surge, leading the Fed to maintain an extraordinarily tight monetary policy. This fear prompts investors to demand higher yields as precaution against potential inflation. The Cleveland Fed Inflation Expectations Index, which predicts long-term yields, shows that the fair value 10-year yield is about 0.4% below current yields. A continuation of the disinflation trend or a recession could significantly reduce those yields. Federal deficits are another key factor keeping yields high, larger than average deficits, partially due to increased interest expenses and significant deficit spending create a bearish skew in Treasury debt supply versus demand. If interest rates fall, fears about fiscal deficits will likely decrease, leading to lower yields. Leibowitz introduces the concept of R star, the real neutral rate of interest, which balances the economy and guides the Fed's interest rate policy. There is no definitive R star, making interest rate management a guessing game. Some believe the R star has increased post-pandemic, justifying higher bond yields. However, historical trends show a consistent decline in R star. New York Fed President John Williams argues against the increase in R star, citing the lack of evidence for rising R star in the developed countries and the persistent forces pushing R star down, such as demographics and debt. Economic growth rates have not improved despite technology advancements, indicating that the factors driving growth remain unchanged. Leibowitz concludes that unless there has been a significant change in the economy, interest rates are likely to decline alongside the mythical R star. The current high rates may not be justified given the unchanged primary growth factors significantly impacting the economic landscape. All right, easy for you to say. Whew. All righty, well, that's everything that I had for today. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone out there has a wonderful evening. And like I say, if you need to reach me, head up to my website. If you need to get your financial crap in order, get your retirement plan, whatever goals that you might have, give me a buzz. I'd be happy to help. All right. Well, that is, like I said, everything that I had for today. And I hope to see everyone back tomorrow. Adios.